Hi, I'm Max Keiser. This is the Keiser Report. Check it out. Jet bomb! We went to New York City, and they downgraded America. S&P did immediately, as we told you they would. Others doubted us, but we guaranteed it. And now we're back in France, and guess what? Stacy Herbert, tell us more.
Well, Max, I'll tell you the headline. As soon as Max Keiser arrives in France, AAA rated France may be vulnerable to downgrade following cut to the U.S.
Yeah, well, there's a tremendous ripple effects, aren't they, with this downgrade? Because the U.S. dollar is, of course, connected to the U.S. Treasury bond market, and it's connected to the thigh bone, connected to the hip bone, connected to the foot bone, connected to the... Yeah, baby, it's all connected. So when you downgrade, you start to pull the thread on the U.S. dollar, the whole kit and caboodle gets unraveled.
Yeah, you might also say, however, that it's all related to S&P itself and Moody's and Fitch, because the U.S. and France are in such bad shape due to all the so-called AAA rated collateralized debt obligations and other credit derivatives that S&P allowed to be rated AAA, and then these countries' banks bought these toxic debts.
Yeah, that's an interesting part of the history, isn't it? You know, during the period leading up to this financial crisis, the selling of collateralized debt obligations, CDOs as they're known, and other flora and fauna of the derivatives sphere spawned by the witch herself, Blythe Masters. Fitch and Moody's and S&P gave these concatenations, these abominations, their AAA rating, and it created this huge Ponzi scheme. Now they've pulled a rug out from underneath them.
Well, Max, another story related to this financial chaos going on at the moment. Bank of New York Mellon charges depositors. America's biggest custodial bank has been forced to start charging customers who have deposits of more than $50 million as more investors take cover from the market turmoil. So they're saying that they're basically trying to force people out of cash and into somewhere else because they're receiving so many people coming in, flooding the banking system with all this cash. Now, this is something we've spoken to James Turk about, where he envisioned reverse capital control, that instead of capital controls being on money being taken out of the U.S., it would be against money being brought into the U.S. in order to avoid the hyperinflation of all those dollars that are overseas.
Yeah, another great point. Trying to stop that money from coming in by charging essentially negative interest rates. People say you can't take interest rates below zero, but you can by charging people to hold their money at the bank. They start off with these big $50 million deposits, and then they work their way down to the mom and popper out there with a couple of $1,000s on deposit. You will be charged 1 or 2% or more at the end of the year. You have that much less in your account as the bank is trying to pay off their bad loans that should have been ring-fenced and dealt with back in 2008, but instead were let to metastasize and grow into this enormous economy-killing tumor of bad debt.
And, I mean, this is another actual point for those who argue that there's deflation, and there are some people who argue there's massive deflation. So here a bank is able to charge money for people to hold this amount of cash. But it also, the article points out that the news of the levy emerged as a sale by the U.S. Treasury of $20 billion of 10-day bills offering zero yields further demonstrated investors have now become intent on preserving capital.
Yeah, the trend is obviously toward negative interest rates, and that's negative purchasing power. And, oh, by the way, that's a good reason to buy gold.
Again, we come back to gold. Well, let's move on to the other AAA-rated securities about to be downgraded. Muni market prepares for lost AAA ratings. So the $2.9 trillion municipal bond market is preparing for hundreds and hundreds of downgrades after Standard & Poor's lowered the U.S. one level to AA+, the first ever reduction for the country. So S&P is likely to cut its ratings on municipal debt secured by the federal government, such as pre-funded bonds, tax exempts backed by U.S. agencies, and credits that are most dependent on federal spending.
Right. The AAA rating of the U.S. Treasury bond is a reference rating that is connected to all these other aspects of the economy, like the municipal bond market. Also, on the corporate side, I was just looking at Zero Hedge. They made the good point that institutions like Options Clearing Corporation or the group that is responsible for clearing of short sales, they're all being downgraded too. So this is affecting the fundamental infrastructure of the entire system itself, is being downgraded as the entire Ponzi scheme unravels.
Yes, I also read while we were in the States that JP Morgan is the next for downgraded by S&P. And the reason why is they said that JP Morgan relies so much on the US government. Despite all their protestations, despite every year when Jamie Dimon collects his tens of millions of dollars bonus, he says, because I deserve it. Nobody works as hard as I am. I'm so clever, I can print money. But it's the U.S. government, according to the rating agencies, that give JP Morgan its rating.
Right, well, nobody works as hard at fraud as Jamie Dimon. But as you point out, all they do over there at JP Morgan is they take the risks on their books and they stick it on the federal government's books. That worked beautifully for years as long as America had a AAA rating. But now that America has a AA plus rating and interest rates are going to, by definition, creep higher, that is going to be a huge wall of arbitrage, interagency arbitrage, fakakta nightmare bamboozlement that will no longer serve JP Morgan in their quest to hide losses. And that stock's going down like a pile of bricks. Short JP Morgan. As a matter of fact, sell it short naked.
In fact, a better naked short at this time would have been Bank of America. If you follow this next headline, Max. Bank of America getting smashed as AIG jumps into the lawsuit fray in a big way. So American International Group is expected to sue Bank of America in what might be the largest mortgage security-related action filed by a single investor. The suit seeks to recover more than $10 billion in losses on $28 billion in investments in mortgage-backed securities.
This again, when Barack Obama came into office, Stacy, by not shutting down the too big to fail banks and by letting AIG live another day, they're committing massive moral hazard on an incredible, epic, biblical scale. Now they're out suing everybody who's involved. All the counterparties here that are suing each other are bankrupt. And they're suing each other for the right to drain the Federal Reserve of more of the citizens' capital. And notice the key word in what you just said, counterparty. You know, this extends to financial markets as well, because when you go from AAA to AA plus, suddenly when you start to downgrade all the institutions that are the intermediaries for all these market manipulating fraud deals, you have counterparty risk. So when they say, well, for example, there's 60 trillion or 600 trillion, derivatives out there, they say, well, it's not really a risk because they're all offset each other through the counterparty obligations. But if the intermediary that's responsible for making those obligations good goes bankrupt, then you don't have a good coverage there. You actually have a $600 trillion risk.
According to the report, there's a growing trend of investors pursuing private lawsuits claiming banks misled them into purchasing risky securities. The trend also stems from the lack of prosecutions on behalf of the Justice Department against the largest financial firms and their executives. So there you go, Max. You talk about Barack Obama refusing to prosecute these people, the too big to fails, the banksters. This is why we're still in this situation. This leaves us up to the biggest firms out there who can sue it, because mom and pop Joe Bag of Donuts can't sue JP Morgan and Bank of America and all these other banks. But, you know, the giant bankrupt organization AIG can.
Yeah, I think this is so important because at the time when they let AIG get away with this massive fraud, remember, and when Hank Paulson went to Congress and extorted $750 billion, it was always, we got to keep these markets open. We can't afford them to go bankrupt. We can't afford the counterparty risk. We can't afford the systemic risk. And Barack Obama just put his thumb in his mouth. Okay, guys, I don't know any better. And now, 2.5 years later, it doesn't matter. Barack Obama, by not enforcing the law, by not following the Constitution, it's going to blow up anyway.
Well, apparently AIG is planning to file similar lawsuits against Goldman Sachs, JP Morgan, and Deutsche Bank. And of course, after that will come the rating agencies, because JP Morgan Goldman Sachs and Deutsche Bank were selling products that were AAA rated by S&P. But with all these things falling apart, everybody losing their AAA, America falling apart into a bucket of fraud and nothingness, I want to bring up one final headline to think of another option, another reality that we could be facing today. What if Barack Obama had been a leader? The bull case for gold. Gold is rising because the world's monetary system is being debased and there's no sign of stopping. Well, what if Barack Obama, instead of engaging in this elaborate, stupid, awful theater with John Boehner, what if he had just come out and said, you know what, forget all these negotiations, we're just going to go back to a gold standard and we're going to value it at $25,000 an ounce. Bye, and just left. And that would have devalued all of their debt and they would be on the road to starting over again.
That's genius. It's the reverse Nixon.
It's the reverse Nixon. Now, Nixon defaulted on the debts of America by dropping the gold standard when he owed all this money to foreign creditors. Well, America's in the same position now, and they could effectively do the same thing. They could effectively default by devaluing against gold.
That's exactly what's going to happen anyway. And Barack Obama, if he were as you say, if he were a real leader and had the cojones of, let's say, a Richard Nixon, which I can't believe I'm saying that, after having been dragged through Watergate as a kid and been humiliated. But compared to Barack Obama, Richard Milhouse Nixon looks like a genius statesman compared to this no spine, leaderless, nobody, bag of nothing, bag of worms. And that's a genius idea, simply, and it's going to happen anyway. They have to bring back the gold standard. The smartest guy out there in the punditry universe, Jim Rickards, he points out that those who criticize this idea say there's not enough gold. And, he would point out, and I would point out, that there's something called the price discovery mechanism. Markets reflect supply and demand. If you have $600 trillion worth of worthless derivatives, well, some of that's going to end up being repurposed as a gold standard at $20,000, $25,000, $30,000 an ounce. That's just the way markets work. Accept market-driven capitalism or go home. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. After the break, I'll be speaking with Peter Schiff. Welcome back to the Keiser Report. Time now to go to Connecticut and talk with money manager, radio show host, author, all-around nice guy, Peter Schiff of Euro Pacific Capital. Peter Schiff, welcome back to the Keiser Report.
Thanks for having me on.
All right, Peter Schiff, as we have been talking about, and as you have been talking about, the U.S. has been downgraded by S&P, their debt from AAA to AA+. Did the S&P go far enough?
Well, of course not, but at least they went in the right direction. And, in Wall Street parlance, any downgrade means get the hell out. They never like to put a sell on anything. So you have to look. If they go from a strong buy to a buy, it means, look out below. And so they did the minimum that they could do. But really what S&P is saying, as far as I'm concerned, is get out of U.S. debt, any dollar-denominated debt, because what they're really downgrading is not Treasury bonds, but the dollar. Because S&P knows, as Alan Greenspan said and Warren Buffett said, they don't have to default. They can print. But that's worse, especially if you're a bondholder and you get paid back with monopoly money. And so what this means is that all debt in dollars should be downgraded, whether it's treasuries, munis, corporates, you name it. If it's paying you back in dollars, get rid of it.
All right, now let's talk about the whole rating agency motif. How they have been, the role that they've played in this crisis and what's been going on in the last few years. Because during the lead up to the crisis that you document very well in your book Crash Proof and Crash Proof 2.0, you talk about how the rating agencies were remiss in that they gave the derivatives, the collateralized debt obligations, and these other concatenations of bastardizations, these securitizations, AAA rating. So why suddenly did they get religion? How did that happen? Because they were in.
Well,
yeah, go ahead.
It's funny that the Obama administration is saying, well, why should we listen to S&P? After all, they got it so wrong with the subprime. They think we should listen to Moody's and Fitch, but they also got it wrong. And what everybody got wrong was they rated stuff AAA that shouldn't have been AAA, and they're still doing it. At least S&P is learning from its mistakes, whereas the other agencies are not. And the Obama administration is criticizing S&P for learning from its mistakes.
Now, it's interesting. I'm looking today, and the unintended consequences, I guess you could call it, because now Fannie Mae and Freddie Mac are being downgraded. Some of the institutions like the Options Clearing Corporation and other part of the infrastructure and the architecture of the markets are being downgraded, and municipal bond markets are being downgraded because the AAA rated of the U.S. government is a reference rate. Can you talk about how this is going to trickle through to these other pieces of the infrastructure and what consequences?
Certainly, because if the U.S. is not AAA, if the U.S. is AA plus, then if you used to be a AA plus, well, you got to go down to AA because you're not on par with the Treasury. If you were somewhat more risky than the Treasury, you're still more risky because the Treasury can tax everybody to pay its bills. And if the Treasury doesn't tax, it prints and it debases the dollar. That affects all bonds, not just its own bonds. But, what's also crazy about the rating system, why is China, the world's biggest creditor nation, we owe China trillions. How can they be rated AA minus? And we're rated AA plus. I mean, what kind of twilight zone world is the world's biggest debtor a bigger risk than the world's biggest creditor?
Yeah, what's Geithner's comments? He says S&P is being irresponsible. Isn't S&P being responsible, like PIMCO is saying?
It's the government that's being irresponsible. They're the ones that are racking up the debt. And, the Obama administration is all over S&P because they claim they got the math wrong, that they didn't count this $2 trillion of assumed savings over the next 10 years. Why should they count it? It's not going to happen. And in fact, the real math problem is with the administration using these CBO budget numbers. All of these deficits assume a rapidly growing U.S. economy for the next decade with low inflation and low interest rates. This exists only in a dream. The reality is we're already going back to recession. So you can take all those rosy scenarios and throw them in the trash can where they belong. The budget deficit is going to be much worse than both the administration and S&P believe. So, they're all wrong on the math.
All right, I'll tell you what, go over that once more just so, because everyone's talking about this $2 trillion mistake. Just review that again, why that's really a false canard in all this. And also comment on Warren Buffett's remark that Moody's, that S&P is somehow wrong and that his investment in Moody's, they're right.
Yeah, of course, people forget that he's got a dog in this hunt because he's a big shareholder in Moody's. And if S&P has got it right, that means Moody's has got it wrong. So when he comes out and attacks Moody's, S&P, he's got an agenda. Also, this guy said that he would buy treasuries even if they had no yield. So, what good is his opinion if it's that moronic? I don't know, maybe senility is catching up with Warren because obviously he can't be as great an investor as people think if he's saying he's willing to buy treasuries even if they pay zero. If that's the case, let's sell him some special treasuries. It'll save the taxpayers a lot of money. If Warren Buffett will really buy our debt if we pay nothing. And of course, he also said that the federal government has a printing press. Well, yeah. What good is that to our creditors? It's great for the government because it inflates away its liabilities, but it also inflates away the public's assets, including the assets of Warren Buffett. Of course, he's criticizing S&P for missing subprime in the housing bubble. He missed it too. He got it completely wrong. In fact, many of his companies might have gone bankrupt if the financial institutions weren't bailed out by the U.S. government. But the $2 trillion math era, so-called, is again based on S&P not calculating the full amount of the savings that Congress claims are going to be made over the next 10 years based on what they agreed to. But almost all of the $2 trillion in cuts happen sometime after 2017. There'll be a different president. There'll be a different Congress. They will not be bound by anything that was agreed to last week. The only thing that counts are the cuts that were made to the 2011 budget, and there are none. In fact, I just heard Barack Obama speaking, last night, talking about the need for more tax cuts. He wants to cut taxes for the middle class and for the the poor, and he wants to spend more money on government infrastructure. That means he is advocating for bigger increases in the deficit right now.
Okay, now you bring something up there. It sounds similar to what was experienced during the Lyndon Johnson kind of guns and butter. You know, they want it all. And this led to huge over expenditures, which led ultimately to Nixon closing the gold window in 1971. Stacy Herbert, who I do this show with brilliantly, asked me earlier in the show, can't Obama, if he was really a leader, do a reverse Nixon and just say we're going to reopen the gold window at $20,000, $25,000 an ounce to inflate away these debts?
Well, that doesn't inflate away the debts. I mean, that is an attempt to remonetize gold, put the U.S. back on the gold standard. Yes, that's what we should do, but there's no chance that we're going to do that, certainly not under Obama. That was the last time the U.S. government actually did default. We defaulted on our promise to pay gold and basically rendered the dollar fiat with no real value. But I think that the loss that you're going to see in the dollar in the decade ahead is going to be far greater than the loss in the 1970s, because the dollar maintained its reserve currency status despite the fact that we defaulted on that promise. The dollar now is going to lose that status. Right now, the only thing that's standing between the dollar and complete collapse is the foolish actions of the Bank of China, the Bank of Japan. The world is propping up the dollar because they believe foolishly that it's in their political self-interest. But as I said, when they figure out it's no longer in their interest, they will pull the plug and the dollar is going to collapse much worse than it did in the 1970s. Hopefully, at some point, we will go back on a gold standard, but the price of gold will have to be much, much higher for that to happen.
All right, let's talk about what's happening over there at Bank of Mellon. They're charging fees on deposits, over $50 million deposits. Can you talk about what this charging of a fee on a deposit means? Is it a negative interest rate? Will we see more of it? In other words, banks charging people to store their cash.
And I think this is a byproduct of too big to fail, because people that have a lot of money want to put it in these huge entities because they feel that they're too big to fail, and so their deposits are safe. But the reality is none of these deposits are safe because they're all denominated in U.S. dollars. So what people need to do is convert their dollars into other currencies or gold. I mean, look at the Swiss franc today. The Swiss franc is up almost 3 full cents. You need $1.32 to buy a Swiss franc. In fact, with the euro at $1.41.5, the Swiss franc is rapidly approaching parity with the euro. And it just took parity with the U.S. dollar. That happened very recently. And now it's at a 30% premium. And look at the Swiss franc. I mean, the yen, imagine where the yen would be if the Bank of Japan hadn't flushed the equivalent of $50 billion down the toilet last week to buy U.S. dollars and, of course, U.S. treasuries. What is Japan doing with all those dollars that they're buying? They're buying treasuries, not because they want to, but because they think there's a gun to their head. But they're mistaken. So instead of paying somebody to hold your dollars, sell your dollars and get into the Swiss franc or get into gold.
All right, we've got about 30 seconds left. I just want to swing back and revisit the gold standard idea. Clearly, as you point out, the problem today is inflation, and by returning to a gold standard, you are coming back with something that would hopefully restrain government from spending and from the printing presses from rolling out at full speed. So clearly, as we were saying before, if you go back to the gold standard, you've got to find a price that would make sense given the fact they've had all this money printing going on for so long. I know you've got a long-term target on gold in the thousands, but have you thought about at what price would
Yeah, I don't know, because it depends on where we are when we go back to the gold standard. Obviously, if we go to the gold standard today, the gold price will be lower than if we go to it 2 years from now, when it's going to have to be that much higher. So a lot of it depends on where we get religion. And of course, it all depends on how much gold we actually have, relative to all of our notes that are in circulation, because it's a relationship between the supply of dollars and the supply of gold that would set the backing and what we're able to give for each of our IOUs. But once we do that, then the spending stops. Then the deficits stop. We can't do it anymore. If we actually go on a gold standard, if it's real, then we have to abide by it. And so I don't think we're going to go to it again until we have a real crisis. As long as the world is buying our bonds, we're going to keep selling them. As long as the world is gobbling up our paper, we're going to keep printing it. As long as we can live beyond our means, we'll do it. As long as politicians can get elected by plunging us deeper into debt, they will do it. It's not until they can't. It's not until there are real consequences, like a collapse in the bond market, a collapse in the dollar that sends interest rates soaring, that sends consumer prices soaring, that tanks the stock market, that puts people in the streets protesting. That is not, until all that happens, we're not going to do the right thing.
All right, Peter Schiff, thanks again for being on the Keiser Report.
Thank you.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Peter Schiff. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.